I want you to think about the most innovative company on earth. The one that put a computer in your pocket, changed how you listen to music, how you pay for things, how you unlock your front door. Apple. 2.5 billion devices out there. $416 billion in revenue last year. A company so valuable, it's worth more than the entire GDP of most countries. Now I want you to think about your bank. Your bank doesn't make anything. It doesn't design anything. It doesn't launch a new product every September that people queue up around the block for. Your bank holds your money. It moves it from one place to another. It sends you statements. Occasionally it charges you $11 because a payment bounced. That's it. That's the product. Here's the part that doesn't make sense. Apple, the most innovative company in the history of capitalism, makes roughly $100 of profit off each of its users per year. Your bank, the one with the hold music you've memorized against your will, makes over $1,000 per customer per year. The most boring product in the country beats the most exciting company on earth by 10 to 1, and most Australians have no idea it's happening. And here's what makes it stranger. Australians complain about their banks more than almost anything. We know the fees are too high. We know the rates aren't fair. We know they post record profits while we're watching the grocery bill climb at Woolies. And yet almost nobody switches. Exposed to 4 institutions we don't trust, paying for a product we don't understand, locked into a system we didn't choose. That's not an accident. That's architecture. This video is going to show you how 4 banks turned the most boring product in Australia into the most profitable business model in the country, how the system was built so you'd probably never leave, and why the answer to both of those questions is uncomfortably the same thing. So here are the 2 questions this whole video hangs on. How does the most boring product in the world, holding your money, generate 10 times the profit per customer as the most innovative company on earth? And why do Australians complain about their banks constantly, but almost never switch? What if the answer to both questions is the same thing? If it is, that changes how you see every dollar you earn, every loan you take, and every statement you ignore. Let's find out. To understand why Australian banks are so absurdly profitable, you need to understand one concept. Just one. And once you see it, you'll never look at your bank account the same way again. It's called the spread. Now, the spread sounds like something an economist would mutter into a spreadsheet at 2 in the morning, but it's actually dead simple. I'm going to be honest. The first time someone explained it to me, I thought there had to be more to it. There wasn't. Here's how it works. Your bank takes deposits from people like you. Savings accounts, term deposits, everyday accounts. It pays you interest on that money. Right now, depending on where you bank, that might be 4 or 4.5% on a high-interest savings account. Some of the big 4 pay less, much less. Then, your bank takes that same money, turns around, and lends it out to someone else. A home loan, a business loan, a personal loan, and it charges them a higher rate. 6, 6.5, sometimes more. The gap between what the bank pays you and what it charges the borrower, that's the spread. That's where the money comes from. Picture Josh. He's 28, just bought his first place in Brisbane. Sat down with a mortgage broker, signed the papers, shook hands, felt like an adult for the first time. His repayment is $2,800 a month. What nobody told Josh is that in the first few years of his loan, most of that repayment isn't paying off his house. It's interest, going straight to the bank. He's 5 years in now. He checked his loan balance the other day and it's barely moved. He thought something was broken. It wasn't. That's amortization working exactly the way it was designed to. The bank gets its cut first. You get your house later, much later. That's the spread in action. And it's not a small operation. The Big Four's combined net interest income, which is the technical term for the money generated by the spread, was over $38 billion in the first half of 2025 alone. $38 billion in 6 months. From the gap between what they pay and what they charge. That's it. No innovation required, no new product launch, no keynote presentation, just the gap. Now here's where it gets wild. The average net interest margin for the Big Four sits at about 1.8%. That sounds tiny. 1.8%. You'd ignore that on a receipt. But when you apply 1.8% to combined assets of over $3.8 trillion, you get a number that makes Apple look modest. It's like a toll booth. The bank doesn't build the road, doesn't drive the car, doesn't choose the destination. It just sits at the gate and takes a cut of every trip. And every dollar in the Australian economy eventually passes through that gate. That's the first principle. The spread makes banks profitable. But here's the thing. The spread alone doesn't explain why Australian banks are this profitable. Lots of countries have banks. Lots of banks use the spread. What makes Australia different isn't the mechanism. It's the structure around it. Stay with me. This next part is where it actually clicks. Australia has something called the Four Pillars policy. When I first heard that name, I genuinely thought it was about architecture. It's not. It's a government policy, informal but ironclad, that says the four major banks, CBA, Westpac, NAB, and ANZ, cannot merge with each other. Cannot. Full stop. On the surface, this sounds like it protects competition. Four big banks are better than two, right? More competition, better rates, happier customers. That's the theory. In practice, the Four Pillars policy does something very different. It guarantees that there will always be exactly four dominant players, each too big to seriously challenge the others, each too protected to be absorbed. It doesn't create competition. It fossilizes an oligopoly. These four banks control over 70% of all financial institution assets in Australia. 70%. Between them, they hold more than $3.8 trillion. They are the first, second, third, and fourth largest companies in Australian finance by every measure that matters. And the policy that was supposed to keep them honest is the same policy that keeps them untouchable. The Four Pillars policy might be one of the most elegant pieces of structural protection in Australian finance. It's also the reason competition in banking is, at best, a performance. Now imagine four petrol stations on four corners of the only intersection in town. They all charge within 2 cents of each other. They never merge. They never undercut by enough to matter. And there are no other roads. That's Australian banking. But the oligopoly alone isn't enough. You still need to understand why customers don't leave. And this is where it gets personal. Picture Priya. She's 32, living in Sydney, paying too much on her home loan, and she knows it. She's seen the comparison sites. She's found a smaller lender offering 0.5% less. 0.5% doesn't sound like much, but on her mortgage, it's close to $3,000 a year. She's ready to switch, so she starts, and then she discovers what switching actually means. She needs to refinance the mortgage, which means a new application, a new valuation, discharge fees from her current bank, new paperwork. She needs to redirect her salary, update every direct debit, move her offset account, transfer her savings, reconfigure her card for all the subscriptions she's forgotten she has. She started on a Saturday morning. She gave up by Tuesday. That's not a coincidence. Switching costs aren't a bug in the system. They're the product. Every layer of complexity between you and the exit is a layer of profit protection. The banks know this. The data shows that the average Australian stays with their primary bank for over a decade, some for life. And then there's May. She's 24, just started her first full-time job in Melbourne. She opened a CommBank account because everyone has CommBank. Her parents had it. Her friends had it. The ATM was near her uni. She didn't compare rates. She didn't read the product disclosure statement. She didn't even think about it. 10 years from now, she'll still be there. She didn't choose CBA. CBA chose the moment she stopped thinking about it. That's the real product, not the account, not the app, the inertia. Quick pause. If you've understood everything up to this point, you already know more about how Australian banking works than most Australians ever will. We're about to get into the part that's genuinely uncomfortable. The part where you realize the system isn't just unfair, it's designed. Here's what should bother you. When the RBA raises the cash rate, and they've done it 3 times already in 2026, your mortgage rate goes up almost immediately. Within days, sometimes within hours. Your bank sends you a polite email, your repayment jumps, and that's that. But when the RBA cuts the cash rate, your savings rate drops fast. Your mortgage rate, that takes its time. Weeks. Sometimes the bank doesn't pass the full cut on at all. They absorb part of it. That asymmetry, fast on the way up for loans, slow on the way down. Fast on the way down for savings, slow on the way up, is how the spread widens without anyone changing a single policy. It's not illegal, it's just profitable. And fintechs, neobanks, the digital disruptors that were supposed to change everything. There's a whole rabbit hole about capital requirements, ADI licensing, and regulatory barriers that I'm not dragging you into today. The short version is this. To seriously compete with the Big Four, you need billions in capital, a full banking license, and the trust of millions of customers who've been trained since childhood to believe that the only safe place for their money is a building with a logo they recognize. Some smaller banks and credit unions genuinely offer better rates. ING, Macquarie, Ubank, some of the mutuals. But the Big Four's market share hasn't meaningfully shifted in decades. The challenges chip around the edges. The fortress holds. Now, picture Tom. He's 45. FIFO worker out of Perth. Earns well. Pays his mortgage like clockwork. Has been doing so for 15 years. One night in camp, bored, he opens a spreadsheet, starts calculating. How much total interest has he paid on his home loan so far? The number comes back. He stares at it. Then he opens his super balance. The total interest he's paid to his bank is larger than the total super he's accumulated over the same period. He built his bank's wealth faster than he built his own. That's not unusual. The Australia Institute found that over the 30-year life of an average owner-occupier mortgage, the Big Four make roughly $229,000 in profit per loan. That's nearly $250,000 from one customer, on one product, over a lifetime. This part still blows my mind. So here's what all of this actually means. And this is where the paradox resolves, or rather refuses to resolve. The Big Four don't outprofit Apple despite being boring. They outprofit Apple because they're boring. The product is so essential, so invisible, so embedded in every transaction you make that you can't leave. Apple needs you to want their next phone. Your bank just needs you to exist. Every time you get paid, every time you tap your card, every time your rent clears or your mortgage debits, the toll booth collects. Apple has to earn your attention. Your bank already has your money. The spread is the engine. The oligopoly is the wall. The switching costs are the moat. And the product, the most boring product in the country, is the thing that makes all of it invisible. You don't think about your bank the way you think about your phone. And that's exactly why it's more profitable. That's the architecture. It's not broken. It's working precisely the way it was built to work. Now let's clear up some things that most people get wrong. First, loyalty is rewarded. No, it isn't. The Big Four have historically charged what's called a loyalty tax. If you've had the same home loan for years without renegotiating, you're almost certainly on a worse rate than a new customer walking in the door today. The reward for staying is paying more. Second, smaller banks are riskier. This one keeps people locked in. Every authorized deposit-taking institution in Australia, whether it's CBA or a tiny credit union in regional Victoria, is covered by the Financial Claims Scheme. That means your deposits are protected up to $250,000 per account holder per institution. The safety net is the same. The rates often aren't. Third, banks earn most of their money from fees. They don't. Net interest income, the money from the spread, makes up roughly 84% of the Big Four's combined revenue. Fees are annoying, but they're the sideshow. The main act is the gap between what they pay you and what they charge someone else. Fourth, the government regulates banks to protect you. This one's more complicated. Regulators like APRA and ASIC do important work. But the Four Pillars policy doesn't protect consumers. It protects the banks from each other. The structure that keeps four giants standing is the same structure that keeps real competition from ever arriving. So what can you actually do? Here's the practical bit. Every situation is different. What you've just learned is the framework, not the answer for your specific circumstances. But there are a few things worth knowing. Call your bank and ask for a rate review on your home loan. Seriously, pick up the phone. Banks have retention teams whose entire job is to stop you leaving. If you've never called, you've never triggered that team. You might save 0.25%. On a large mortgage, that's thousands a year for a 15-minute phone call. Compare your savings rate. The Big Four's standard savings rates are, frankly, embarrassing compared to what smaller institutions offer. You don't have to move your whole life. You can move your savings. Understand your offset account. If you have a mortgage and a lump of savings, an offset account reduces the interest you pay. If you're not using one, you're leaving money on the table every single day. Use a mortgage broker. For now, brokers force the banks to compete for your business. The Big Four are actively trying to reduce broker influence, which tells you everything you need to know about how much brokers cost them. That cost is your saving. And if you want to go deeper into the mechanics of getting your banking sorted, the Barefoot investor remains one of the most practical Australian-specific starting points. The ACCC also publishes comparison data that most people never look at. You don't have to become an expert. You just have to stop being passive. So here's what you now know. 1. The spread is how your bank makes money. The gap between what it pays you and what it charges someone else. And it's responsible for the vast majority of their profit. 2. The oligopoly is structural, not accidental. The Four Pillars policy, the switching costs, the sheer inertia of banking with whoever you banked with at 18, all of it is architecture. And 3. The Big Four don't outprofit Apple despite being boring. They outprofit Apple because they're boring, essential, invisible, embedded, and almost impossible to escape. Most Australians will bank with one of these four institutions for their entire lives without ever understanding the machine they're inside. If you now see it, you've already changed the conversation. You don't have to tear the system down. You just have to stop pretending it was built for you. If this video means that one person calls their bank tomorrow, checks their rate, and realizes they've been paying a loyalty tax for a decade, that's the whole point. Remember that number at the start? $100 versus 1,000. Apple versus your bank. Now you know why. The most boring product in the country doesn't need to impress you. It just needs you to not think about it. And until today, it was working. This is general education, not personal financial advice. If you need advice tailored to your situation, speak to a licensed financial advisor.